Welcome everyone who's here in person. It's so fantastic to see people's faces again. Yeah, just so delighted to see many old BWC members and many new ones as well. So thank you everyone for joining us here in person. And to those joining us on Zoom, thank you very much as well. And hope everyone has been able to attend some of the sessions during BWC's annual meeting this week. This is our capstone session. We're very excited to be ending on a very high note here. But we've had a really rich week of content and discussions. So I hope you all were able to tune in for a lot of that. And of course, you can always find recordings on our website. So I am very pleased today to be here with this distinguished panel, who also all happen to be members of Bretton Woods Committee's Digital Finance Project Team. And our project team is just getting up and running and releasing their very first report, the brief that you all have on your seats here today. And what we're going to do today is we're really going to dive into this first report and to some of the issues that are in this brief, and then some of the ones that we're going to be tackling in subsequent briefs as we go forward. So I also want to remind everyone we always will save time for questions. So for those of you in person, if you have a question, just raise your hand and we'll have someone coming around with microphones. For everyone on Zoom, please enter your questions using the Q&A function in Zoom and we'll collect those as well. So let me briefly introduce our panelists before I turn it over to them. You all, of course, know our chair of our board of directors, Mr. Bill Dudley, who, of course, was the former president of the New York Fed and is at Princeton with his project team co-lead, Carolyn Wilkins. They share, I think, or have side-by-side offices at Princeton. So a good team there. And Carolyn is, of course, an external member of the Financial Policy Committee at the Bank of England. Adam Schneider is a partner in Oliver Wyman's digital and banking practices here in the Americas. And Natalia Thakur is co-founder and COO of Knox Networks, and also co-founder and advisor at the Stanford Future of Digital Currency Initiative. So welcome to our panelists, and I'm going to turn it over to Bill and to Carolyn to share a little bit about what's in this brief.
Okay, so I'm going to take the big picture view about how did this brief actually come about and how does it fit in terms of the broader efforts of the Bretton Woods Committee. And Carolyn will get into some of the detail of this first brief. You know, when you think about what the Bretton Woods Committee's mission is, it's all about facilitating multilateral cooperation and coordination. We live in a global financial system, we live in a global economy, and we've seen the consequences of what happens when that isn't respected. Historically, the Bretton Woods Committee has really been mostly about the IMF and the World Bank, but we feel like the issues where multilateral cooperation and coordination are relevant also extends into the global financial system, extends to the BIS, the FSB, IOSCO, et cetera. So we felt that it was important to broaden our mission to reflect that. And so we developed a Future of Finance working group to think about what topics should we work on in the financial space where a Bretton Woods Committee could make a difference in a way that's consistent with our mission of facilitating cooperation and coordination. And we came up with two work streams. First work stream is the one we're going to talk about today on digital finance. And the second work stream, which the project team on climate finance is going to tackle, is on climate finance. And that's headed by Asana Dechel. That's on a little bit slower course than this. You have to walk before you run, but that will be up and running in the fall, following on this one. So why digital finance? Well, first of all, it's global. Second of all, it's evolving very quickly. And third, it's not very well understood and not very well regulated. In fact, you could argue it's not even regulated at all. So the paper we're publishing today is really the first in a series of 8 briefs that we're going to do. And the key thesis is just that, we need to understand this business better. We need to regulate it better. We need the regulators to be more proactive at regulating it better if we're going to make any progress here. Our central thesis is if we don't do something soon, there's going to be a significant accident. And we're going to be like, oh, why didn't we do something to regulate and put this under control? That would be rather unfortunate. So Carolyn's going to talk about the first brief in more detail. So this is our first brief. It basically lays out the roadmap for the subsequent work that we're going to do over the next year. The second and third briefs, and we're going to get into some of this, some of the second brief today, is on the use cases. Okay, so if you really believe that what's happening in digital finance is relevant, you have to believe that there's actually some positive use cases that digital finance can do things better than how we do things in traditional finance. So we basically decided that we need to establish that there are these positive use cases. The third brief is on technology. Well, there could be positive use cases, but if the technology is no good, you're not going to be able to take advantage of that. So the third brief is really exploring what's different about the technologies in the DeFi world. What contributions can these technologies make so we can actually have better outcomes in terms of cost, efficiency, safety. So once we've done that work, so we know there's positive use cases, we know the technology has promise. That's the motivation for starting to dive deep into particular segments. You know, if there were no positive use cases and the technology, stinks, then we don't need to do any further work. So we want to sort of create this basis of work to motivate what comes after that. So after that, we're going to do a deep dive into stable coins and unbacked crypto assets. You know, how should they be backed? You know, what needs to be done in terms of appropriate guardrails. Then we're going to look into investor protection, market integrity. You know, what does good governance look like in organizations that are highly decentralized? If something goes wrong, who do you talk to? The next topic we're going to get into is all the security issues in terms of any money laundering, BSA, illicit activity. You know, if things are done in an anonymous way, how do you prevent bad activity? The seventh topic will be on the crypto assets, their relationship to central bank digital currencies. We're probably going to have both. And the real question is, how are they going to interact? And what's the appropriate role for crypto assets versus central bank digital currencies? And then finally, we're going to try to tackle a more metaphysical question, which is, given all this, you know, if you're looking out 5-10 years and you're thinking about how all this is going to evolve, what adjustments do we need in how the global financial system is structured to accommodate this new activity in a global way? So that's the roadmap. You know, we'll probably add briefs, you know, as we get new ideas, but this is sort of the body of work we want to accomplish first. We're trying to do this for with two goals. One, we think this needs to be explained better to people. And two, we really want to light a fire under the regulatory community to start moving more quickly here. Because if they don't move more quickly, we're going to have a bad accident. So with that, I'll turn over to you a little bit more about our first brief.
So this is an incredibly exciting subject area, just because it's the first time in a long time that we've got what could be a real change in how the financial system is wired. And you know, that motivates people on both sides, the traditional system and then the entrepreneurs on the other side, to really get into this development phase or a phase of trying to protect your own interests in the traditional side that I think has created a dynamic that's made it hard for us to move forward on the regulatory side. And our thesis is that there actually is some societal value that could come from many of these new asset classes, new ways of doing financial intermediation in a distributed way that merits the right kind of regulatory attention. And so you know, one of the really interesting things about this space, and we'll probably get into it, is that it's really not anything new that there's been a quest for cutting out the middleman or through decentralization or to become more efficient. We all know that major financial institutions still have COBOL in their. I think most of the people that know how to program in COBOL are retired by now, but they still have it. And so what our paper tries to do is really set out the lay of the land, but take the positive part seriously. I know as a part of a regulatory community still that we tend to say this could be good, but and then we think all the things that are bad about it. And I think it's really important to set that out like we do in the paper, in a way that gives a sense to both sides that there's something here to preserve and protect and help this new world, I guess, succeed and fail in a safe way. So, Bill's talking about an accident. Accidents always happen when you innovate. What you want to do is you want those taking the risk to be the ones that either gain or lose because of it. You don't want people who didn't understand the risk or society as a whole. So
Innocent bystanders.
innocent bystanders to take the risk. And so when we think about this, the way the working group kind of cut it up is, well, there's the crypto assets themselves, there's unbacked crypto assets like Bitcoin, Ether, others, and then there's stable coins that are backed by assets of one form or another. And the idea that we wanted to have behind making that distinguishing feature is that the positive use case for each is really different. How you might regulate them would be really different. And so just stablecoin, for example, if it says it's backed by assets, then you want to make sure that it actually is. You want to make sure that whether is it a money market mutual fund or is it a bank? What kind of entity is it, and how can you make sure that the money is actually there in the stable coin to keep its value stable or to pay out if there's a run. So that's just an example of the type of regulatory issue that comes up there. We also talk about DeFi. Everybody in the newspapers is so obsessed with Bitcoin that they forget that distributed finance is actually a new financial ecosystem that's being built that creates financial services that we're very familiar with: payments, lending, taking leverage positions. You can invest in an art form like an NFT, or you can use it as collateral for a loan or another financial transaction. And this whole new ecosystem, there's a great table in there that I quite like that sort of says, why is this valuable, potentially valuable? And it's because it can fix some of the problems that exist in the traditional system where everything happens in silos. You can't talk to each other. It's not transparent. And the list goes on, but of course, and now I'm going to get to the of course part, is that, well, we're going to see familiar risks too, that come from crime, financial crime, money laundering, terrorist financing, getting around sanctions. You could have people losing their money because of fraud, people stealing it. And so you can have financial risks building up in the system to a point where they actually become systemic. I'm just kind of going up the escalation thing, where we know from history that when things grow fast and become intertwined with the rest of the financial system, that you can have a really big accident, as you put it. And that accident just doesn't cost those who invested in it money, it costs the taxpayer money, because it can create economic and financial stress in a way that we need to think through how to manage it. So all that to say, there's a lot of work to be done. And I think that for the businesses out there, their focus may not be on avoiding financial stability, but their focus is going to be on, that's not their job, but they want to manage their own risk well. The good business people do. And they need the regulatory certainty to be able to build their business cases. So I put my hat on, the business hat on, and I say, well, if I don't know, in the paper, there's a list of questions, a short list. The list is probably much longer than that, but if I don't know what clients am I allowed to serve, how do I know when my rules are going to change because I'm coming too big or too systemic? How do I know what the regulatory expectations are with respect to governance? Even in DeFi, it's not fully distributed. So how is the regulator going to think of conflict of interest in my case? They don't have answers to those questions. It's kind of hard for them to actually, they're not licensed. It's kind of hard for them to thrive within the regulatory system. And so our big challenge and our big call to action is to help in whatever we can with our work, increase understanding, but also push the regulators and the legislators forward to think in the US, it's more US focused. How do we make this safe, but in a way that institutions can thrive? I guess the last thing I would say is that because it's global, there's no way that the US or any country could do this work without integrating it with the international financial institutions that do global kind of regulatory norms. And so the role of the Financial Stability Board, the Basel Committee is super important. I think another thing that will be important is that the work that's going on in central banks with respect to central bank digital currency, and I'm looking at the governor of the Riksbank, who's a leader in this area. We should ask him a question later. It's going to be intertwined with the crypto world. It's going to be intertwined with the future of money. It may not be the initial motive, the reason that central banks are looking at it, but certainly in the modernization framework, central bank digital currency is a big thing. That's another area that needs to be coordinated internationally. So I guess the final message is, for all of us thinking about this, we need to keep our mind on the positive use cases before we go so quickly to the risk. We need to engage with people in the industry, which we have in our working group, to actually understand what's going on. And I think we need to encourage legislators and regulators to keep moving forward. And the president's executive order, which some of you may know about, is a really good start to that.
Thanks, Carolyn, and thanks, Bill. I mean, I think that the brief is very thoughtful, and the work stream that you have put forward is robust and the right issues to be looking at. And you have a great working group, a great project team that's helping you work on that. And we're going to dive into more of this here now and bring them in. But I want to ask an opening question to everyone. And Bill and Carolyn have really outlined sort of the explosion in the crypto market and have made the case for sort of urgent attention and regulatory action. But the blockchain technology has been around since it came about in response to the global financial crisis. I was sharing at lunch today with some people at my table that Bretton Woods Committee actually hosted an event on digital currencies and digital payments in 2015. And the IMF at that point hadn't even undertaken any analytical work on this. So it's actually been around now for some time. So why has it taken so long for this to kind of rise to a level of attention? And maybe Natalia and Adam, will start with you and then come to Carolyn and Bill.
Yeah, so I think from my perspective, first of all, this is an industry where what you learned 4 months ago might already be outdated. And so it's very hard to stay not only in a position where you can be timely reactive, but essentially even proactive. I think the second thing is that for policymakers in specific, my understanding is that policymaking comes from situations and data, and it takes a while for a new technology to actually get to a level of scale or specific use cases for there to be enough movement or data on something that then a policymaker can come in and say, okay, I'm going to put these guardrails or this type of framework around it.
Adam?
Well, thank you. Thank you all for the opportunity. It took a long gap between inventing the wheel and having the car. So that's normal. People are working, they're grimbling, they're understanding the tech, they're commercializing it, they're trying to get it to be functional. And that's all happening in R&D labs, in the corners of banks, in corners of people, and in corners of Bretton Woods and IMF. But once it got to be obviously commercial and obviously economic, and not 6 transactions a second globally, which was the original blockchain, but reasonable productivity, there is an S-curve explosion of capability and then people and organizations using it for good function. So we're just seeing that, the first leg of that S-curve take off right now. And yes, it took years, but that's not that atypical.
Yeah, I would absolutely agree with that. I mean, you look at electricity developments, and then when it actually gets incorporated in manufacturing, there's about a 20-30 year gap between when you could have done it and when you actually did do it. So it's pretty, it takes a long time for people to get reorganized. And it takes a long time to figure out what the best uses are. I mean, I think another thing that probably slowed it down is, Bitcoin and blockchain, they're together, but they're also apart. And so I think, my own personal view of Bitcoin is I'm not a huge fan of it because I don't see it as a stable store of value. I don't see it as a great efficient payments medium. It's just throughput's really slow, really expensive. But I think the blockchain part is really quite innovative. And you can see blockchain being used for a whole host of things. I've talked to some people in major commercial banks who think that the blockchain is going to be a great thing for trade finance. Because trade finance is like keeping track of who actually owns your stuff as it goes through different places around the world. And if you have a immutable ledger of where the stuff is and it can't get double counted, that's a pretty valuable technology to use for trade finance. So here's something that started out with Bitcoin that's probably going to ultimately be very, very useful for trade finance. It takes a while for people to figure that out.
I think that from the regulatory side, you know, that white paper came out in 2009, and what else was happening in 2009? And then what was happening after that? It was a lot of regulatory reform to make markets safer, to make financial institutions safer. And so when I was on the Financial Stability Board and we were thinking, what is our work agenda going to be? FinTech, let alone focusing on crypto, was like, well, we can't do that till we finish, you know, solving too big to fail. And it was just, there was a bit of that.
Basel III, we're still working on
We
that.
were still working on Basel III. And so, and thank goodness we did, because I think it was what made, you know, the situation with when the pandemic was declared and all that market turmoil wasn't as bad as it could have been because banks were safer. That being said, you know, at one point, we knew central banks around the world knew that we had to understand the crypto world better. And that's why many central banks, including the Bank of Canada, I was there at the time, I started up our projects working with blockchain technology, not from the point of view that we wanted to regulate this space immediately, but we needed to understand it. We didn't, a lot of hype at the time, still is a lot of hype, but we knew it was going somewhere. And if we weren't on that train early on, then we would have a hard time making sound judgments about how it should be regulated later. And so that learning phase is not a 5-minute thing. It's a big thing. I think that now central banks, regulators are pretty motivated to get to it. But the last point I'm going to make is you want to do it right. I think that as much as we hate risk, we don't want to step on regulation or step on an innovation that could have societal benefits in a system that's clearly so inefficient right now. Just think about the cost of payments. And we need to build the relationships with the people working in that industry so that we can understand how things really work. And that takes time building relationships. We're doing that with banks and others for years, maybe even centuries, and for some central banks. And this is really new. So I think there'll be a nonlinear response, if I can put that. Now that there's focus, I think things will move on the regulatory side.
Yeah, I mean, I think part of the problem is regulators are by nature somewhat risk averse because their job is to prevent bad things from happening. And it's a lot easier to prevent bad things from happening by saying no than let something innovative happening and not knowing where it's actually going to go. So I think regulators have a little bit of aversion to approving someone's application to get into a new business in a totally new way, not knowing what precedent they're setting for other people to apply and how this could evolve. And 10 years down the road, something could blow up and people would go back to that person. So why did you approve that application? So easier to be very, very, very slow and reluctant. I think in the current circumstance, that's a mistake. I think the regulators need to lean in. Now, not lean in to say, we're just going to regulate you just like we traditional financial institution, but focus on outcomes. What outcomes do we need? How do we need this new industry to perform under stress, and figure out what regulations are needed to accomplish that ends that work in a way consistent with the new technology and business model. So you don't just take the old regulation, just sort of port it in. You try to work with the new applicants. How can we accomplish these outcomes in a way that makes your business still feasible? That's what you want. You want to sort of that iterative approach. But to do that as a regulator, you have to be expert about what the technology is. You have to have people on your staff that can make informed judgments. And you also have to be willing to say yes rather than say no.
And I want to come back to regulation, but kind of following the logic of the brief and that you all have laid out, that there is fundamental value and benefit from this technology. I want to ask Adam and Natalia, who are working on the next brief, which is going to be on use cases, what are the positive use cases? And maybe what are the ones that we are seeing not exactly work out in real time? Adam, you want to start?
Sure. I don't think you could have predicted that Bitcoin would lead to stablecoin because it took time for the markets and people involved to evolve. So just generalize that a little bit. There's a huge positive use case of reinventing financial products. That things that simply will work differently, maybe more efficiently, maybe more effectively, maybe more economic for the end user. And we're seeing many examples, product by product, of essentially attackers trying to go at the financial system to reinvent various aspects, from payments to tokenizing balance sheets to new models for international payments, as Bill said earlier. All of these things are coming in and knocking on the doors of traditional financial institutions. So it isn't in our heads a Bitcoin versus stablecoin conversation. It is the evolution of financial products using this technology that has enormous benefit. And you're going to watch them move and grow at the speed of code, as opposed to the speed of legacy systems being updated in traditional business models. Because the old little firms, I mean, 1 out of 10 will succeed, 1 out of 100 will succeed. But those others will explore all kinds of interesting niches and ideas that are beyond what the financial system can do today. And yes, we're seeing a lot of that bubbling up.
Yeah, so the 3 use cases that we chose to focus on were digital identity, payments, and DeFi. And they're really strong use cases because they're sort of the half step to what everyone's building for the next 10 years. These 3 use cases fall within the bridge of bridging the traditional finance system to the newer financial system, and realizing that you're going to have to change your operating models or part of your integrations to make sure that, you know, you can't just implement decentralized identity overnight, right? Banks would take a lot of issue with that. So on the digital identity front, we've talked a little bit about, you know, this idea of KYCing through verifiable credentials or zero knowledge proofs. And maybe we're not at a state today, for example, where a third-party person that would put out a verifiable credential, which is, you know, basically a hash of information on, you know, a certain human being, that maybe we wouldn't trust third parties today, but maybe in this half-step system, you would have a bank issue a verifiable credential, or a suite of banks agree that that verifiable credential could be used to verify a customer through KYC. Within the payments use case, you know, it's not just about central bank digital currencies. There's one part of that where you could say, okay, countries are going to come out with different systems. What we really need is one platform that allows interoperability between all these different central bank digital currencies. That's what the BIS is really working on. They're trying to position themselves as an interoperability power player. But even beyond central bank digital currencies, there's also a lot of Web 2, you know, kind of innovation in that space. So for example, we're seeing what's happening with FedNow, or RTP is coming out with new systems, and they're also trying to get a play in like the payment space. And then finally with DeFi, I think Adam really touched on those points. But yeah, talking about the bridge between the traditional finance system and the new system, and that bridging that half step.
Sticking on this interoperability concept, I mean, this is really a central concept to the ecosystem, right? And so I'm interested to hear, you know, kind of your thoughts on this in sort of 2 dimensions. So one is sort of, what are the barriers and possible improvements to interoperability between the emerging crypto ecosystem and traditional finance, and then sort of in the DeFi system itself? Natalia, do you want to take that one?
Yeah, I can kick us off and add. So in the payments, like let's just say the payments ecosystem, so bridging traditional finance into the new space, I think the biggest first step is, what does interoperability mean? It can mean a lot of different things. And then what is the catalyst for helping that become an actuality? So definitions of interoperability, for example, could be interoperability between different types of tokenized assets. That's different than interoperability between back-end platforms. And that's different from interoperability of financial standards, NACHA, SWIFT, ISO 20022. Then from there, you can say, well, what's a catalyst for that? Because interoperability means you're playing with existing systems and future systems. over time will evolve into all future systems. And, open source is something that keeps getting thrown around as a helpful tool or catalyst to reach that. I think on the DeFi end, I see interoperability as interchain interoperability, which means we're considering composability of blockchains. Now, what's great about that is composability is a feature of blockchain, but at the same time, on the negative side, it can allow for a lot of interdependencies between chains that might not have common governance systems, risk evaluation, et cetera.
So I'll add in, you would think there's one blockchain because that's how it's phrased. There's 1,500 and counting. And of course, that's like saying there's 1,500 types of currencies, which doesn't make a lot of sense. And when you kind of go to root cause, where are the standards? Where are the global capabilities? Central bank digital currencies will actually be an interesting use case because the central banks actually know who they are and can talk to each other very directly. It's close to 1,500. And there's still no global standards, although I hope BIS is driving in that direction. So global standards, how to pull it together, how to have this stuff so there's not 1,500 things, but I don't know, a database would be a reasonable supposition, is the type of thing that has to happen for us to go forward. There's a possible next generation, which is much more of a balance sheet view. Banking system separates what I've deposited from where the assets are deployed. Key accounts, basic stuff. There's none of that in the environment we have with blockchain. I literally own a wallet, or I can own 1,500 wallets. And there's no easy, natural consolidation mechanism for what I own for where it's deployed. And there's a theory that I may move in that direction as well. But all of this is very nascent, and it's a real problem.
Yeah, the common standards for the 1,500 blockchain sounds like a big challenge to me. Okay, so we talked about kind of Bitcoin leading to stable coins and maybe the sort of store of value thesis not holding as much. But in this high inflationary environment, there's been a lot of discussion about that and kind of using it as an inflationary hedge. Do you guys buy this argument, crypto as an inflationary hedge? What do you think? Adam wants to start.
I'll editorialize. Bitcoin is a technological model, but it's essentially a proof of concept that took off, not the product we would build today the way we build it today. So, and I have this horrible analogy, which I hope is not offensive to anyone. The Indians sold Manhattan Island for $24 in trinkets, or so they say, to the Dutch. We don't think of that as the way real estate finance should work. That was just an interesting proof of concept in the early stages. We remember that story. Bitcoin is that type of thing. Bill is completely right. It works poorly, has lots of issues. Whether it's a store of value depends on the global geist of minds, as opposed to any backing of any government. No one controls it. No one owns it. That's kind of good and kind of awful at the same time. It's obviously subject to everyone deciding it's a bad idea. And will that be a store of value for inflation? I know many smart people who think so. I get very suspicious around this because certainly it hasn't yet as a practical matter, and nowhere near the store of value of many other possibilities. I do think we'll use this proof of concept and evolve into something that can be much more stable, used, speedy, efficient, effective. And that may well come, and maybe that's the direction of stable coins, but I don't think Bitcoin is that.
We're right on this cusp of this big change from proof of work to proof of stake, right?
Correct.
So and that's a pretty substantial change that pretty complicated to do, and we're going to see if it actually, but it's hugely important because the amount of work that you have to do to create the blockchain goes down dramatically if this works.
You can, I'm a central banker, so it's not at heart. So it's not surprising that I don't view Bitcoin as being money or a store of value. It is speculative investment, which means it's different. It's different to say it's not an inflation hedge than to say you can't make money buying Bitcoin, because obviously over time people have earned returns and lost. So you just need to look at the chart. And so as an investment, that's a different thing. And empirically, you can just look at how it behaves relative to other assets that are inflation hedges or not. And when you do that work, some of the correlations change over time, number one. And number two, it tends to be more like an equity, a long equity play. I'm saying this in front of people who give this advice, so I'm feeling a bit nervous about that. But it doesn't behave like, and you look after the Russians, it doesn't behave like gold. It doesn't behave like a flight to safety. It hasn't been behaving. And Bitcoin itself may be growing, but as a share of the total market, it's actually falling. And so I find the narrative that this is the safe haven kind of play and the way to avoid inflation to be a little bit fine to believe it if you can take the risk. But from a consumer protection point of view, I think that, regulators along with people who give investment advice can do a real service to people if they're informed and there's the right guardrails that let them know what exactly they can afford to risk and what kinds of risks they're getting into. And that's back to our call to action. Want to buy it for the right reasons and in the right amount.
Yeah, exactly. We're not going to help you what they need to do. I think the genius of Bitcoin was the fact that only 22 million were ever going to be made just by construction. So that creates this idea that there's no way that you can sort of debase the Bitcoin. And that's what gives people reassurance to buy Bitcoin, because there's only going to be so many ever created. But the problem with that argument, as I see it, is, yeah, that's assuming that people want to use Bitcoin for something that actually has some underlying utility. Why can't Bitcoin be just replaced by another digital currency, another crypto asset that just has superior performance to Bitcoin? If that's the case, why would people want to continue to hold Bitcoin? So I think Bitcoin, potentially what we're going to see is, yes, it's true, there's only so much Bitcoin that's ever going to be produced, but Bitcoin will probably ultimately be eclipsed by something that's better, And at that point, people say, well, why am I holding this Bitcoin cryptocurrency when there's this other cryptocurrency that's much more efficient as a payment mechanism, much more stable store of value? This is better than this. And at that point, I think some of the support for Bitcoin will evaporate, which is my personal thesis.
So thinking about the technology a little bit more, we talked about interoperability, smart contracts. And Natalia, maybe we'll start with you on this. What are the benefits of smart contracts, and how do you think about programmable money? And then Bill, I know you and I have had some conversations about smart contracts. I'd like to hear from Natalia, and then maybe hear from Bill.
Yeah, well, programmable money, first of all, it's a very broad umbrella term. There are lots of different types of programmable money, and so it really depends on how you define it. But I think that if you were to think about benefits, programmable money ideally is something that allows you to achieve scalability, interoperability, and some form of privacy. And then you have sort of what are specific use cases, either on the wholesale or retail side, that allow, programming of certain assets to allow you to have access to analytics or data that would, be relevant for institutions. So you can think about, can you program money to, be spent on certain items? Can you program it to only have identity verification above a certain threshold of transaction amount? Is there ways to program it so that you can, if you have a policy that you're implementing and putting a pool of money into a community, that you can understand if the money is actually kind of making it at a pseudo-anonymous level to where it needs to go. So I think I'm curious to hear what other people's thoughts are. The projects that I've worked on, like we are trying to redefine what programmable money means away from necessarily what we think of normal crypto assets to be. Bill?
So I think it's pretty fascinating innovation, because it's so simple. If this, then this, and there's no way it can't happen. So there's sort of like a confidence that if this conditions are satisfied, then this other thing is going to happen. You don't have to worry about someone messing it up. The only problem that I sort of see with it is, how do you decide if this happened? Because if you look at how smart contracts are structured, they have to go to some outside source of information to verify whether this happened or not. And so I like it, but I still feel like there are some potential points of weaknesses. If the oracle is feeding the information to the smart contracts are reliable, then it's going to work very well. But if you get in a situation where people can manipulate the oracles or somehow distort the oracles, data feed into the smart contracts, then you have a problem. So I like the idea. I think it's really actually very, very promising. But you're going to have to figure out a way to make it so that people can't, game it. I mean, it's like the analogy that I use is LIBOR, right? LIBOR was a perfectly fine thing until people realized that, boy, we could set LIBOR in a way that could manipulate the Eurodollar futures market and make a lot of money. So it wasn't LIBOR is the problem. It was the fact that there was this prospect for manipulation. And so I worry about the linkage between the smart contracts and the oracles.
I'll add a comment. I'd like us all to remember they're not smart and they're not contracts. That's okay. It's a wonderfully named product. So as I really think product expansion and evolution is the basis, there they are. But the whole regime we have around managing models, model risk, contract risk, and all those capabilities that we've embedded in the banking system over about a decade, we need that times 9 for smart contracts because they're making financial decisions. If they go the wrong direction, really awful things happen. The testing standards, the quality standards, the code standards, the production standards, the model risk management standards, all of these have to be applied to any high-value smart contract. I would think for me, at least, to get comfortable that they will execute correctly on time. And I think we have to look at that in the mirror and say, okay, that's right.
Well,
Yeah,
and
you have to make sure that they can't be
They
manipulated.
can't be manipulated from the outside data, which they
And-
used to be in-house and now is external.
And how do you make sure that the coding is always correct? And if something goes wrong, who do you talk to? So there are some issues to work out.
Well, and just to kind of play devil's advocate on the philosophy behind it, I mean, isn't some level of discretion good in some cases? And it seems to me that smart contracts essentially seek to eliminate.
Well, yes and no. I mean,
Yeah.
finality is good, right? To know that when I make the payment's money good, and there's no settlement window that you have to, have uncertainty about whether I'm actually going to get the obligations actually going to come back to me. I mean, that's one of the biggest risks in the financial system right now is we still have settlement risks. I mean, think about stocks, equities in the United States. They still sell T+2 days. I mean, that's sort of nutty, right? I mean, really, it take 2 days after you make your stock trade that it actually finally settles. That's a big source of potential risk. That some of these things that are automatically executed could actually, collapse significantly.
Yeah, and I think that the governance issues about the Oracle, about who takes the decisions, what's the fiduciary duty of different players in that system, because there are kind of central players or players that have some power relative to others. What's the governance? Those are treatable issues. We deal with them in the traditional system. It's not like these issues of runaway contracts or runaway behavior of financial players hasn't happened before. And so I think that it's just, we need to have a conversation with the community in a way that they're open and we're open to kind of figuring out how do we sensibly put guardrails around it to minimize the risk that you end up with the kinds of problems you think, because the benefits removing a lot of costs, a lot of middlemen, a lot of frictions that give you T+2 and all the risk that's worth something.
Yeah, you sort of want to focus on what can go right, but also you want to focus on what can go wrong.
Yeah.
But you want to have those two ideas in your head at the same time. The regulators focus on what can go wrong. The innovators focus on what can go right. And we need to sort of get them to meet in the middle.
And I think for large financial institutions, like the back end office stuff, like programmable money starts to sound really good. Delivery versus payment, a lot of some of like the inter and intra-bank transactions that need to be done or kept aside, they're super manual processes. However, when you start to think about programmable money from almost the retail perspective, then you start to get into the conversation of like, well, how programmable? Who's doing it? Is it a surveillance system? So it's also really thinking about like, who is your audience? Also kind of like caters to how you talk about it and, not only what is the technology, but what can it achieve and what are the guardrails for each of those audience members?
And I'll add a guardrail that traditional finance has. Well, there's a balance sheet there. I mean, I think we've all seen operational problems and technological issues that have caused monetary things go on. And when there's a big balance sheet behind it, you have a layer of safety that is different than a smart contract put up by a startup that's living in the cloud with an ownership structure that's not clear. And that is a huge advantage in the side of traditional finance. So there's no question that there are guardrails, but some of them are just like this capacity to absorb a problem.
I think taking some of these use cases and benefits, and we've talked about some of the risks, but let's dive into risks and regulation now. You know, I think, and I'd really like to hear from all of you on this, sort of what risks in this crypto ecosystem are highest on your radar, and then what does effective regulation look like? Carolyn, you want to start?
Well,
Give you all the hard ones.
so I think that consumer protection and market integrity are at the foundation of financial stability. It's not financial stability per se, but if you don't have trust in the financial system, you don't have stability. And I see that trust is high right now for the believers, but it can be eroded really quickly. And my worry is that if we don't shore up, you know, those who are not supposed to be able to manipulate the markets that they actually can, or those that shouldn't be stealing people's money or giving them bad advice and saying, buy, all your retirement should be in Bitcoin, that is going to not only hurt individuals, but it'll hurt the tarnish the reputation of what could be a very promising new ecosystem. And so that really worries me. And good regulation, in my mind, is where businesses actually know what the rules of the game are. The rules of the game don't change too much over time. And for those that have good business models, they may have more irritation and may not love all of them, but they can still see a way to making money and contributing in the way that they want. And that means regulators have to answer a lot of questions, some of them in our paper, that haven't yet been answered. And that means that businesses need to help regulators get there by coming halfway to the table. And I see that starting to happen, but more of it needs to happen.
The regulators are not really giving the industry much of a roadmap of what do I need to do so I can get access to, say, that's payments settlement system. And if you don't know what the answer to that question is, it's pretty hard to figure out how you structure your business in a way that can achieve what you want to accomplish. So I really do think the regulators need to do more about specifying what they're for, You know, what's acceptable to them, what level of risk are they willing to take, or what are they willing to offer in exchange for a firm that stipulates that we're going to do things in a certain way. You know, the classic example is Facebook with Libra. And then my understanding of what happened there is Facebook went to the Federal Reserve and basically said, we want to do this in a regulated way. And there was a long conversation between the Fed and Facebook. And Facebook mostly said, yeah, we'll do that. But the conversation just kept going and going. And there was sort of like no bottom to the questions coming back from the Fed. And eventually, Facebook, which is now Meta, decided that we're not getting anywhere here. And so I think that's what we want to avoid. We want to avoid the regulators just sort of bobbing and weaving and not providing guidance. And it's hard to provide guidance when this is evolving so rapidly, but you got to start somewhere.
Yeah, Natalia, Adam, I mean, I think from an industry perspective, I mean, the criticism is always that industry doesn't want any regulation, right? But we don't think that's the case here. What are your thoughts?
I think one of the risks is like the disintermediation of banks. Like, I believe that we should continue to have a two-tier system. And that's not to say that an ecology of digital assets can't coexist. In the same way we have cash today, you have, you know, PayPal, Venmo, you have like your cryptocurrencies. Not to say that every digital asset is going to fall under a two-tier banking system, but there needs to be banks there to provide liquidity to the overall financial system, where other digital assets are just not going to quite cut it, to be honest. I think separately, another risk is just cybersecurity threats. And as quantum computing becomes bigger, the security of some of these digital assets are going to wane. So how do we make sure these new digital assets are quantum resistant? How do we think about cybersecurity? A lot of payments solutions in Web 2 and Web 3, you're picking at the same problem. You're either taking a blockchain or a database and you're trying to put as many assets on that database or blockchain as possible and move it as fast as you can. That's still a single point of attack. So how do we think through different mechanisms like sharding and distributed systems that can allow us to think through, okay, is there a way to make sure that there are no single points of attack as computers and hackers and other bad actors get smarter and more scalable?
When I think about this problem, I don't come from the regulatory side, I come from kind of the problem side. The companies we work with actually want a good roadmap to know what to do. When I think about kind of what are we trying to go do, and regardless of who regulates it, because maybe it's not a bank, and maybe it's not a this, and maybe it's this. Customer money needs to be protected. Seems like a pretty simple thing. The equivalent of the FDIC for the equivalent of deposits, or the equivalent of the money market rules for the equivalent of those funds. Some way to be comfortable that if you have a cash-like equivalent, it's there, and there's some insurance layer or some guarantee layer, so it just works. And that would, if be that industry, be that government, be that rule setting, that would open up the gates in a lot of ways. Similarly, on the asset side, I have tokens and today they are stolen. Okay, we can't actually have a situation where your assets are reasonably routinely once a week stolen by hackers. You need a regime, and I'll pick on SIPC, which is an industry organization, that makes sure that if your big broker fails, your assets at some level are there, regardless of what happens. And they have resolution authority, that's just FDIC and a failed bank. Those things simply have to be thought through. That we know our customers are good, that we know our KYC is at a certain standard, that we know our AML processing is at a certain standard, that we know the sanctions, if and when they're enacted, are enforced. These are all things that have to survive the transition to DeFi, and that if we need new mechanisms and new capabilities, we just have to start with those are the end cases, use cases we have to have for this to be comparably safe as the existing system.
The word sanctions. Thinking about that, obviously that's getting a lot of conversation right now in terms of, the risk of using the technologies for, illicit activity and sanctions evasions. Kind of how high of a risk is that on your list, and what can be done to address it? Bill, you want to start?
I think it's a pretty high risk. Right now. I mean, I think that's, obviously a way by which people will try to avoid, use. I mean, sanctions are all about, reliance on the dollar payment system, reliance on SWIFT. So if there's another mechanism that allows you to stay in business, operate outside of that, then that's going to be a viable option to you if you're operating under sanctions. So I think this will be definitely a potentially attractive. I think the broader issue though about sanctions is really more about the dollar as a reserve currency. If you're putting on sanctions that are basically making it really impossible to use dollar as a payment medium or as a settlement medium, or you're not allowed to really use the dollar assets that you hold because you can't liquidate them and get out of the dollar. I mean, one of the interesting I think findings of the Ukraine-Russian war was that Russia has a huge amount of reserves, but a lot of those reserves are in dollars, and they're actually turning out to be pretty useless to Russia. So I think the sanctions issue, from my mind at least, at this point, is really more about, is it going to undercut the dollar as a reserve currency if you keep using sanctions as a weapon? And I think the answer is probably not, as long as the sanctions are not used capriciously. If they're only used when people violate international norms and people recognize that they're violating international norms, the only people that are going to try to get out of using dollars because of the risk of sanctions are people that are already, thinking bad thoughts and wanting to potentially do bad things. So I think, at the end of the day, the reserve currency is basically driven by, I always say, three things: one, convertibility; two, rule of law; and three, deep liquid capital markets. And the U.S. still has all three of those things. There's not really anybody really quite competitive with. The Chinese would like to be competitive, but they don't really have the deep liquid capital markets. Not even clear the convertibility is always going to be there. And the question on the rule of law is also a little bit of a question. So I think, the dollar is going to have a lot more life in it. The question is, what's the form of the dollar going to be in terms of how we transact in dollars, how we move that money around.
Clearly, the capacity to avoid sanctions existed before Bitcoin, which just provides another avenue. It's dark web, and
Well,
People would be-
cash was a movie, right?
cash was way. People have found ways to avoid tax laws and other laws for centuries. So this just maybe makes it a little bit easier, but you got to remember that it's quite volatile, and it's not. You have to be set up, and so. I think what it does, though, is for those who had the vision of kind of the stateless world, the stateless payment mechanism where there wasn't any censored, I think Lutheran called it like censored access to the financial system. This just kind of reinforces the desire to have that stateless activity. And not all of that stateless activity would be legal, by the way, some of it. Where I see the issue is that it just over time it just increases Russia and China's and others' desire to provide payments rails, not crypto-based payments rails, but regular-based payments rails to do their transactions bilaterally without having
Like an
to
alternative,
use-
alternative to SWIFT.
like the alternative to switch is the message mechanism already exists, but they need the payments rails as well. It's not just the messaging service, it's the rails. So that's just going to increase their desire to build that, which would create some difference in capital flows and sort of maybe a bit more of a fractured financial ecosystem, but that's really, or international financial payment system, but that's different from saying, okay, now we've got a different reserve currency because it needs all the things that you just mentioned. So I think that if I'm thinking about the businesses that I see at the Creative Destruction Lab at Rotman School of Management in Toronto, which I would highly recommend you have a peek at. These businesses are not only building themselves to create new tokens or new crypto opportunities, they're creating crypto forensics. And these are like super exciting businesses that are trying to take on Chainalysis, which is the major. And because they see this as a durable market that's, this is going to be around for a while. Everything's on the blockchain. Yeah, there's ways to hide it, but there's a real business need.
Record doesn't change.
There's a big business need and an opportunity to be able to exploit the transparency of the ledger for forensic purposes.
All right, I want to, unless Natalia and Adam have any further comments, I want to talk about one more topic before we open it up for questions from the audience, and that is CBDCs. We've talked a little bit about these, but I think this is a lot of the conversation in Washington this week, and we've heard a lot from the IMF. I think Managing Director Gorgieva said they've surveyed their membership, and 100 countries are looking at the development of CBDCs. Of course, we know the U.S. is thinking about a digital dollar. She cited that the first to get over the finish line was the Bahamas, and the sand dollar, which is, I think, there's a use case there in emerging markets, I think, that to be discussed. But so I want to kind of hear panel views on CBDCs. Are they complements to or substitutes for stable coins? And then what lessons can we learn maybe from the Bahamas or maybe from China, who have issued their digital yuan? So maybe Carolyn, can we start with you on that one?
Sure. That's a big question. So I just need to say that given that the Bank of England's looking at the central bank of the currency, these are my views and not the Bank of England's views, just to be very clear. No decisions being taken about what they want to do, but certainly when you look at what central banks are producing now, and the BIS, it's all about the positive use case for a central bank digital currency, not a defensive play against crypto assets or DM or whatever. It's really the positive use case, and the view that there's a way to leverage a central bank digital currency, not only to provide a public good, which is a riskless means of payment, but also to create the foundation on which other innovations can be built. And there's a great paper by Kristen Catalini, who was part of the DM project, that argues just that. for example, that stable coins and central bank digital currencies can coexist. And so, yes, they can coexist. Depends on the design, which we don't want to go into those details. That'll be one of our papers, but it's definitely possible. I mean, for China, kudos to them. They were working on it forever to get that out. It's maybe too early to say the lessons with respect to it, but I would say that the one defining feature of a central bank digital currency is a choice about privacy. And aside from the KYC, AML stuff, it's the degree of anonymity that you can enjoy from this cryptocurrency, from the central bank digital currency. And I would say that Western, parts of the world, so Canada, UK, US, would put a much higher priority on privacy. I know the Bank of Canada has been very clear that they would respect the privacy laws. And I think that means a lot of things with respect to the design, but also the desire for people to adopt it.
Natalia, I know that you've made some comments on
Oh,
this
yeah.
and have worked
This is
in
my
this space.
favorite topic.
Yeah.
I mean, I think Carolyn touched on a lot of great points. Something that I mentioned earlier is that we really need to be thinking about interoperability between these CBDC systems, because like you said, China's system might look maybe more like a surveillance system than a country that
I
might.
didn't say exactly that.
Well, but I said that.
Could be.
But I think that that's something that needs to be really focused on. I think the point on stablecoins could be a design output of a CBDC, but I think there is some more belief now that maybe stablecoins aren't exactly the right way to design it. Now we're seeing even other types of proposals being put forth. So Representative Lynch just came out with the eCash Act that said something more like maybe a CBDC could look more like digital cash. And here's what that means. You can preserve the anonymity of cash. It has, these types of features and characteristics. So I think the conversation, which is a positive, is we're trending in the direction away from stablecoins. Stablecoins will still be very important to DeFi and the broader digital assets ecosystem, but that CBDCs to actually have a place in society where they can scale for countries, they can scale across different financial and regulatory regimes, will need to be maybe designed a little bit differently.
So in my view, CBDC is inevitable. We would design it that way today if we weren't already set up. The use case and the operating model, lots of choices. We've done full papers on, does it go wholesale? Does it go retail? What are the benefits? What are the problems? I know there's a lot of people all across the system that would like to see the Fed get into KYC, for example, just as a bit of like spite. But the wholesale version, almost inevitable tied to that. Whether it goes retail, it's going to be country by country. There are major benefits, there are major issues, and there's a lot of things to be worked out. Interoperability, obviously required. Just, but
Two-tier versus not indirect or direct.
right,
That's also another
but
one.
required.
Yeah.
Because why wouldn't you design it in a way where it could work that way? This is a fresh bill. Stablecoins. Stablecoins are akin to money funds. Money funds didn't kill DDA accounts. DDA didn't kill money funds. They have different use cases. They have different value. You can use them in some cases as a settlement vehicle for investments. You can use them as a cash alternative to DDAs. Almost certainly they'll live parallel to the existence of the CBDC, which I suspect won't ever pay interest. When all is said and done, doesn't make a lot of sense for the central bank to pay interest. Whereas the stable coin is essentially the working capital of the sponsor and actually pays significant interest. So I tend to see them as different use cases. I do think the operating model for the CBDCs would be wonderful to clarify that across the 11 at a minimum, but still up in the air as a concept of evidence.
Bill, final thoughts on CBDCs and maybe implications for the US dollar?
Definitely coming. I mean, I think there's no question that a digital version of cash is better than cash because you presumably it's done properly, your security is much greater, and you can carry a lot more around with you if you want. So I think it's definitely coming. I think it's going to be a wholesale central bank system in the United States. I don't think it's going to be retail. The Federal Reserve is not going to want to get into the business of providing accounts for hundreds of millions of people. It just would disintermediate the banking system in a major way. But there are some, downsides of digital currency. That one of the downsides of digital currency that I think we need to think about from a financial stability perspective is that when people want to flee into safe assets, it's going to be a lot easier to flee into safe assets when you have a digital currency than when you have cash. So when you have a panic, you could see a bit bigger consequences to risk assets. So that's something that we need to sort of think about, that we may want to put limits on how much people can have in a digital currency, to sort of put limits on that. I do agree with Adam on stable coins. I think stable coins are like near cash. And so they're not quite as good as cash. They don't have quite the same liquidity as cash, but they're going to earn a positive rate of return because they're going to be invested in near cash instruments like treasury securities. So I think, obviously if we're in a 0% interest rate world, stable coins aren't going to do very well relative to a digital currency. But if we're in a positive interest rate world, then I think stable coins will be fine. So I think the economic environment will also influence how this plays out. But it's definitely coming. I have no doubt about that.
Okay, we've covered a lot of ground. Why don't we see if there's any questions from the audience? So ask you to please raise your hand, and we have microphones. And then I'll take a few questions from the audience, and then we'll see if there's any questions from Zoom. Yeah, I see hands over here first. Correct? Yeah, right where you are. Thank you.
So in an ideal world, what would you choose to be the governing body for cryptocurrencies? And the reason I ask, I know, so nice, but I had to ask because it's taken us a long time to mitigate tax arbitrage. So you can only imagine if we have all these countries setting up rules of regulatory arbitrage with that. So maybe start with something that's more global rather than country-based. And so I will be kind and start with Adam.
Oh, no.
Oh, yeah.
You have to start with Bill. Oh, no.
Just give him a moment.
Oh, no. I will punt right away towards my right.
Boy, that's a nice question. Obviously, you want to have it done at the global level, but it's not obvious exactly who that would be in the current state. I mean, we do have the Financial Stability Board, but the problem is that's all by just consensus. You do have the BIS, but that's mostly by consensus in terms of the policy setting teams. BIS could play a role though, because I mean, as I talked to Augustine a while back, and he did mention that settlements is in the name. So I think there is a potential role for that. But I completely take your point. You want it to be global. You don't want it to be every national body developing their own thing, and then at the end saying, oh, these don't really fit together properly. But I think it's going to be very challenging because we don't really have the body that's been empowered to take on this task, and that's unfortunate. I mean, just broadly, looking at the international world right now, we are in a bad place. We do not have the right international regime in place to deal with the problems that cross national borders, be it security, be it economic, trade. It's not really working very well. So we can't do it in areas where we've been working on for many years. It suggests to me it's going to be pretty challenging to build this up from scratch for this new ecosystem. So I agree with you. We need it, but I'm pretty pessimistic about how fast we're going to get it. So,
Yeah, it's interesting because the BIS is on the financial side is the entity that comes to mind. The thing about crypto is it covers more than just financial. And it also has a technological aspect that's digital. So there's digital finance, there's digitalization, AI, that whole digital governance that needs to be global as well. And I was part of a panel on economic resilience, part of the G7 last year, an external panel that the UK was running. And one of our recommendations was that we create an international body that did digital governance. That crypto and part of it would have been in there, and that they coordinate like the others with the financial side, the BIS and the others, but that there was a real gap because part of this really is a digital build. You're thinking about Web3 and how does that come about? And I have to say that it's on paper it could be a great idea, but the appetite to create yet another international, governing body is like really low. For obvious reasons, because
timing doesn't seem to be so good right now.
Yeah, and so to me, it's I guess part of my answer is I think we think past the crypto and think about the broader digitalization and what that means for international governance of digital, which that could be part of.
Okay, other questions, hands raised? Yep, Elena, right there.
So implicit in a lot of the discussion, of course, is this idea that there's not enough competition in the existing financial system. And implicit in the idea, of course, is that the existing banks are not doing enough innovation, and therefore we need some outside actors to come in. So is the conclusion, and are we saying that the existing banks don't know how to innovate and they're not investing enough in innovation? Or in many ways, in particular, when we think about disruption, of course, that requires often a whole new framework, which is of course really hard when we want to also take care of financial stability at the same time. So the main question to the panel really is, are we saying that there's not enough competition in the financial system and that the existing banks don't really know what they're doing?
It's hard to innovate against yourself. You know, in other words, if you're in a position where you're making a lot of profits and you're threatened by an outside challenger, it's very hard to innovate against yourself. That's going to actually lower your profitability and lower your margins. We've seen this over and over again historically. That's, I guess, observation number one. Observation number two is the inertia in the existing large banks is enormous because of the technology that they're using a totally different technology. You know, legacy system, really hard to, I mean, you know, this is not like, you know, we do one version, then 2 weeks later we do another version, 2 weeks later we do another version. That's not how your world works. This is a world like we decide we're going to do a new release. We'll see you in 5 years. With developing a new system to replace the old system. So it's a very different mindset in terms of, you know, I think the other thing, I'd love you to talk to this. I feel like the technology and the business is much more closely joined in the digital finance space than it is in traditional financial firms. I feel like in traditional financial firms, it's like, we want you to do this. And then there's some people down in the tech area have to figure out how to do that. They're not really talking to each other in sort of a real-time basis. You know, in other words, the technology itself is not really decentralized.
Yeah, go ahead.
There's the world has changed, right? 20 years ago, we weren't online. There was no information. There was no Google. There was no Amazon. There was no Facebook. All of these things have evolved over time. So right now, who knows more about you? Google or your bank? I pretty much postulate it's Google. And that's 20 years where the banking system could have, for example, invested in learning more about you. But for the reasons Bill said, more or less did not. Now, have they optimized what they do? Yes. Have they put web scrapes and you can see things? Yes. Can you do payments instantly in Zelle? And that's sure. But at the end of the day, banks tend to be product-centric, much less customer-centric. And the customer centricity is what has been driving a lot of the change across the internet, across the innovators. This is classic innovators dilemma. 1,000 little companies, 990 will fail, 10 will change everything. And that's what's happening right now in this space.
Yeah, I was just going to say, I actually do feel like the big banks are doing more on the innovation side than we think, except they're just doing it either within their own bank or they're doing it within a small group of banks. Like think about Finality, for example. Now, the problem here is that when you're innovating within a bank or within a small group of banks, you can't get to the scale that you would necessarily want to get to versus fintechs, on the other hand, are much smaller. Their businesses are much smaller. They've been built in a different age of technology, and integrations between different fintechs and different systems is quite easy. What banks get to is that they're developing things, but they have such big business, requirements in terms of like the different things that they cover. And then on top of that, they have some systems that are like dinosaur age old systems. They have some systems that are newer, but those systems aren't necessarily mapped to the systems that another bank is using. And so I think the problem there is more about integrations. And I think something that was mentioned at the beginning, their operating model. So I don't think they're not innovating. I just think that there's other issues that make it hard for them.
I wouldn't put the onus only on the private banks. You think about central banks, regulators, cross-border payments are a perfect example where there's a great paper by the CPMI that talks about the pain points of cross-border payments, most of which are under the control of CPMI and governments and central banks. And they kind of went, oh yeah, it's working. Let's reduce the risk. It's working fine, but we're not going to think about, the future of payments. And those projects are enormously hard to do, even within a country. FedNow is so there's only so much that a bank can do. They're operating in an environment that has underlying infrastructure, regulatory, in other words, that they work with. And so usually they need somebody to coordinate. It's worth for them to make that effort if everybody makes the same effort. Externalities, right? Those network, somebody needs to be in the middle, pushing things along. And so I think, there's a real energy now with the BIS and the CPMI they've got a roadmap on how to fix kind of the traditional system, but it took somebody coming up at their heels and biting at their heels in a contestable markets, competitive markets way to get that wake up call. And so I think that contestability has had a positive outcome for the traditional system in that way.
Other questions? Maybe we'll take a couple at a time. If there's multiple hands, Mahesh.
Thank you very much. First of all, my compliments to the team for having understood and explained clearly, relatively clearly, what is obviously such a vastly complex new system of payments and financial innovation. It is just staggering. I come from the structured finance markets where complexity was actually a cause of the problems. Okay, Volcker famously said the greatest innovation in I don't know how many years was the ATM. You remember that. When you look at all this, there are two observations I have. One, the complexity is going to limit us to going from a wheel to a car. There is so much more complexity than in a wheel to get to the car, which took forever, that I just don't know what is going to actually fly and become something that requires regulation. You have so many 15,000, whatever the number is, and growing, and you have the backed and the unbacked. So my question is, where are you going to focus on regulation? And will the purpose of focusing on regulation will actually kill some things and promote things, indeed save the existing system? Isn't that the bias?
That could be the bias. We would argue that should be the bias. I mean, you want the regulatory regime to be sort of level playing field. In other words, we want to generate the same outcomes. We want to generate the same outcomes by having the most efficient regime in place for both parts of the system. And the risk is that it won't be a level playing field because they'll just say, well, we have these regulations for the existing traditional financial intermediaries. We're just going to port that over to the new thing. And if that happens, it's probably not going to be as efficient as it could be. So, we'll see. I mean, like the original question, I mean, why haven't we seen more given all the blockchain and Interoperability? It's still really early days. I mean, I think we're going to have a much better sense of this 10, 15 years from now. I think I don't know what you Italian, I don't know what you think the right time horizon, but I think it's going to take a while.
We're just beginning to see the operational improvements in core settlements, for example, just turning on. Finality is an example, which I think is never actually finalized anything yet. So we're beginning to see that in core banking things. The innovative products without a lot of the risks and controls working terribly successfully are coming out right now. It's 5-10 years away before we'll be able to say, okay, we kind of got it right. And the only reason it's 5 or 10 years is that tech moves so quickly. If it was the traditional pace, it would take 20 or 30 years.
So it's complicated, it's true, but if you look at a diagram of who's involved in cross-border payments, it looks pretty darn complicated. There's all these players, the correspondent bank, and then your banker, and then this other. It's complicated. And if you ask my son, he's 23, about NFTs, what does he think about them? he doesn't think they're that complicated. He's been playing video games all his life, except for maybe before he learned how to use the computer. And for him, it's just an extension of what he's done. So what's complicated is kind of what I know and what I don't know. And that's why we're so keen to have this group, because there's different people, so that we can, I think NFTs are different, right? I didn't play video games like my son did, but I want to understand it. And then once you understand it, all of a sudden it's less complicated. That's maybe more of a philosophical point, but I think that's why it's so important to keep an open mind, while at the same time not being naive about some of the risks that are there that need to be managed.
Other audience questions? Yep. David.
What's the right balance between privacy and combating illicit finance and tax evasion, and supporting law enforcement?
I think that's for democracies to determine where they want to set that balance. I mean, I don't think there's a right answer. That's a decision about how you want to balance those two things, would be my answer.
I think that's why they have privacy laws. And I think that's why some central banks will say we're going to abide by the privacy laws. And one of the things we forget is that privacy has a social value. It's not just because you want to do bad things that you want it private, it's the social value. And so that's what democracies decide. And different countries have different cultures. They come out in different places on that.
Elena, do we have any questions from Zoom that we should take? Okay, any one final question back here, it looks like.
Okay, thank you. This may sound very primitive, but it's useful to ask primitive questions. In this audience, you will have always very supportive environment for regulations and making sure that undue risk are not run, etc. So that part is well taken. No? I have the opposite question, namely, to what extent, given these new methods of payment and whatnot that exist, aren't we overdoing the concerns about regulation? And in the process, we may run the risk of throwing the baby with the bathtub, or is it the other way around? Bathtub with the baby. And therefore, whether the question to be raised from now on is what can be done to rely as much as possible with the governance structure that exists and make the parties really responsible for what they are doing, so to avoid more and more regulations. I am asking this for one reason. If I look at the last 10, 15 years of how the transactions are being done, I see more and more and more checking the box type questions and controls, etc., which I don't see the value added for them. They may exist, but it's very remote for me and for many others. Therefore, is it conceivable in this group that someone of you with a tremendous hate against more controls and more regulations can look at all this across the board, see what needs to be pruned, see how the regulations are so well focused so that they do perform the role that you have defined? I'm sorry for the primitiveness of the question.
The baby with the bathwater question. I've heard it a few times this week. Who wants to take a stab at this?
I'm going to start with what I said were fundamentals. My deposit equivalent has to be safe. My securities or token or equivalent has to be there no matter what happens, even if the entity fails. If we have terrorist issues and democracy reaches rules that we need to that customer validation, we can't have funds that have KYC and funds that have no KYC, which is literally the case today. We have to have the basic set of safeguards around the financial system so that we know that the assets are safe, the customers, the right customers, and the set of government restrictions, for example, sanctions are followed. I think that's kind of jacks are better on that personal question. That's not that high a bar, because without that, we know that there will be runs on the bank that cause up the damage. There will be runs on companies that bankruptcy that cause damage. There will be illicit activity that causes damage. et cetera. So I think that that level of stability is there. Getting there consistently globally, that's definitely a Bill Dudley question.
Oh, we want to, I mean, I agree with what Adam said, that's sort of like the minimum standard, but then let's get there in the most efficient way.
Right.
You know, let's not, we want to have the least cost solution to generate those outcomes.
Right.
And that's where the regulators and the practitioners need to be in much closer contact and communication about how do you do that? There's a different business model, it's a different way, different technology. And so just porting over the old regulations are not going to be very efficient.
Okay, well, I've learned a lot today. I hope our audience has. I think the mandate of the working group to really educate on this complex system, as Mahesh mentioned, is vital. And so I really look forward to subsequent briefs and learning more in this space and seeing what you all come out with in terms of this regulatory mix of effectively regulating the activity that we're looking at. And I want to thank our audience for joining us in person today. Those on Zoom, we are going to have a reception. It's going to be out on the terrace. If you go out these doors, there will be staff that will direct you there. So we hope everybody will stay and join us for a drink afterwards. And that's a wrap on Bretton Woods Committee's annual meeting. So thanks everyone for being here.
And I just want to thank Emily and Elena and the rest of the Secretary of Staff for putting on a terrific week. They can now take a deep breath.
We get a glass of wine.
Thank you.
Thank you.